Christopher Leonard, Kochland, The Secret History of Koch Industries and Corporate Power in America. In the introduction to the book summary of Kochland, The Secret History of Koch Industries and Corporate Power in America, by Christopher Leonard, we delve into the fascinating yet enigmatic world of Koch Industries. The journey begins when Charles Koch takes the reins of his father's empire and guides the reader through the company's strategic growth, decision-making, and expansion into new markets. As we explore the intricate web of businesses, subsidiaries, and innovative techniques employed by Koch Industries, we uncover the secrets behind its rapid transformation into an economic powerhouse.
The rise of Koch Industries. When Fred Koch, the founder of Koch Industries, died in 1967, his son Charles inherited the family business. Charles was the perfect fit to take over since he was detail-oriented and mathematically gifted, unlike his elder brother. He made two major moves, the first being to consolidate all of his father's corporate entities into a single business called Koch Industries, and the second was to acquire a business that provided the cash needed to pursue his quiet growth vision. Charles preferred to fly low, below the public radar, and never relied on ostentatious branding or overt innovation. Koch Industries' cash cow. Koch Industries bought out other shareholders entirely, acquiring a minority share in an oil refinery located near the Pine Bend Bluffs natural area outside Minneapolis, Minnesota. This acquisition brought about a constant and reliable cascade of cash for the company. Pine Bend had a significant advantage because it imported almost all of its oil from Canada, and few refineries in the U.S. had the necessary equipment to process Canadian oil. Because there were limited buyers for sour oil, the price remained relatively low, making it possible to buy cheap from Canada and sell dear in the U.S. Additionally, President Richard Nixon's Clean Air Act, passed in 1970, contained a loophole that only applied to new refineries. Pine Bend could keep running at full capacity with less worry about competition emerging. The solid income from Pine Bend made it possible for Koch to undertake its next move, expansion. Koch Industries' early success. In the 1970s and 1980s, CEO Charles Koch expanded Koch Industries by acquiring oil pipelines, barges, and trucking services. One of these acquisitions, Koch Oil, provided valuable information about the oil market, which enabled the company to forecast oil shortages and excesses and adjust its market position accordingly. By 1988, Koch Oil was the largest purchaser of crude oil in the U.S. and major oil companies were forced to use its services to transport oil from remote locations. Meanwhile, Koch's access to market information allowed him to acquire a Corpus Christi refinery that produced paraxylene, an essential component for making synthetic fibers for plastic bottles and food packaging. This acquisition led to an immediate doubling of paraxylene production at the plant. Koch Industries' early success was centered on physical growth and financial gain, which had its darker side. The Koch Method. The book reveals the infamous Koch Method that oil companies used to exploit Native American lands and steal millions of dollars worth of oil. The Koch Method involved recording falsely low and high oil levels before and after draining wells, resulting in 2 inches of free oil. While other companies had negligible excesses, Koch Oil didn't pay for thousands of barrels of oil each year. The investigation into the case died eventually, as the documents that could have proved the executive level's involvement were accidentally destroyed. Koch Industries, the cost of maximal production. Koch Industries, a company focused on maximal production, faced a series of environmental law violations over the years. Pine Bend, the company's primary profitable refinery, processed over 137,000 barrels of oil per day, but that led to increased pollution. Rather than shutting down production, Pine Bend chose to drain the high ammonia wastewater into surrounding wetlands, which ultimately led to a hefty fine. Similar violations occurred at Corpus Christi, resulting in $20 million in fines and 312 oil spills over 8 years. Despite the historic numbers, Koch Industries could handle the fines. The company's approach to maximal production had costly environmental and safety consequences. Koch Industries expansion. In the early 2000s, Koch Industries underwent an extensive process of corporate restructuring and expansion. The company's new policy, 10,000% compliance, ensured total adherence to the law, and they sold off non-essential assets to simplify the business structure. Koch then acquired numerous companies through shell companies, making deals that added thousands of workers to their existing 15,000. They maintained a thick corporate veil to separate parent companies from subsidiaries and load debt onto target businesses. In 2005, Koch made its largest acquisition to date with a $21 billion bid to buy Georgia-Pacific outright. Koch brothers' war on climate legislation. Charles Koch and his brothers' immense political influence apparatus played a key role in killing the American Clean Energy and Security Act, ACES, a bill that sought to reduce greenhouse gas emissions. With their funding of multiple think tanks, a Washington, D.C. lobbying office, and Americans for Prosperity, a conservative activist group, Koch pressured Republican senators who might approve ACES. Americans for Prosperity organized transportation for and gave information to disgruntled voters, leading to the defeat of the bill. The Koch brothers' free market priorities led to their war on climate legislation and the creation of a new market for pollution. Koch Industries' fracking gamble. Koch Industries' massive profits were due in part to their strategic investment in fracking technology. By gambling on the viability of Eagle Ford Shale, Koch Industries capitalized on the economic potential of light crude oil. Hundreds of millions of dollars later, Koch Industries' pipeline and shipping investments paid off as Eagle Ford Shale began producing millions of barrels of oil daily. The advent of fracking has led to a revolution in the U.S. oil industry, and Koch Industries' profits have soared as a result.
In conclusion, Kochland provides readers with an insightful and comprehensive summary of the complex world of Koch Industries. Through meticulous research and captivating storytelling, Leonard exposes the inner workings and key decisions that drove the company to achieve its multi-billion-dollar status. Striking a balance between economic strategy, corporate culture, and political influence, the book sheds light on the company's commitment to stopping stupid. While highlighting a significant transformation in the U.S. oil industry, Kochland serves as an engaging exploration of power, growth, and the story of a secretive corporate empire that continues to shape America.